Today marks the end of the 7th week of 2025, and for those who are still celebrating Valentine's Day, happy Valentine's Day. Now, this week we saw the release of the US inflation data as well as the retail sales. They were not pretty. In midweek, we saw the release of the Consumer Price Index or CPI number. The month-over-month number actually inched up higher at 0.5% compared to the December number, as well as the core CPI numbers, which is excluding the food and energy component, also rose 0.4%, which is double of what the December number of 0.2% was. So that was not good. Now, the year-over-year CPI number was no better. Both the headline numbers as well as the core CPI numbers year-over-year rose 0.1% compared to December at 3% and 3.3% respectively. So both numbers actually show or suggest that inflation remains a problem, and in fact, it has been rebounding since last June. And this is the 7th month of a consecutive rise in the CPI numbers. On Thursday, we also saw the release of the Producer Price Index, or rather the Core Producer Price Index, which actually was the highest since March 2023. So again, all the data suggests that whether it is wholesale inflation or at the retail level, inflation remains relatively sticky. Now, what did the market in was actually on Friday when the US released their January number for retail sales compared to December of 2024. And that saw a drastic drop in the retail sales from a very healthy 0.7% positive to negative 0.9%. So that saw a 180-degree turnaround in the retail sales, suggesting there was a collapse. And I suppose we can read into this data suggesting that there was a revision for the December number to 0.7% from 0.4%. So again, this suggests that US consumers may be actually front-running the numbers because that was actually happening ahead of Donald Trump's inauguration on January 20th. So this number does suggest that the upward revision in the December number saw a major spike and then followed by a dramatic turnaround, suggesting January saw a total collapse in retail sales. So again, we want to take this with a pinch of salt. However, Wall Street actually initially reacted negatively to this number in the retail sales, but by the end of closing on Friday, the S&P 500 was flirting with the all-time high. So what does this suggest to us based on the chart? And I think the chart suggests that we may still have some room to the upside because the fear of the Federal Reserve cutting interest rates is no longer there. However, we do see that the possibility of the Federal Reserve maintaining their monetary policy the way it is currently for the next few months, perhaps all the way to December 2025. So that could actually underpin the market, technically speaking. So let's refer to the chart and take a look. I'll be referencing the CME Micro E-mini S&P 500 futures to illustrate where I think the S&P 500 futures may be heading, at least in the near term. Overall, based on the daily time frame, which is the chart you're watching right now, and referring to the March 2025 futures contract, the last traded price on Friday was 6,133.75, and it is down 1.5% compared to the previous day on Thursday. But for the week, it is also down 1.39 points, and but for the year so far, it is up 3.3. So we can see that overall the bullish outlook in the S&P 500 remains very much intact, and the most recent high was 6,163 even, as you can see over here, and the market is gone sideways. Basically, what I'm trying to impress upon you here based on the daily time frame is that the bull market is very much intact, and what we are seeing here is just a sideways consolidation with a little bit possibility of further consolidation going forward. Now, let me refer you to the next lower time frame, which is the 4 hours time frame. So in this particular chart here, which is the 4 hours time frame, you can see very clearly the most recent high at 6,130.63 even has seen the market gone out to as low as 5,009 35.5. Okay, and the market has been trading within this band of prices for quite some time, and we do see a initial three-wave pullback from the height of 6,163 even all the way down to 5,948 even before it bounced back to 6,147.3 quarter, and then finishing at a low here at 6,935.5. That complete the first initial three-wave pullback, coming very, very close to equality, which was actually at 5,932.35. It was very, very close. I would think that that would suggest that it has completed the first corrective pullback. Now, the other possibility is that this bounce from the 6,935.5 resulted in a high of 6,147 even on Friday, and this could be building up for a possible larger degree three-wave pullback to perhaps in this area here, highlighted at 5,865.75 to 5,919.5. Now, this is another alternative possibility here. But I think based on what we see on Friday, despite the disastrous retail sales, prices managed to recover back to challenge almost the all-time high. I think it has basically underpinned the bullish case. I won't be surprised if when the week open now on Monday is President Day, so the market will be closed in the US. However, when the market reopen on Tuesday, there's a possibility the market may continue to edge higher. And once it takes out 6,163 even, the market could be targeting this level. My initial projected target is 6,221.5. So this remains the current target for now if the price goes higher, regardless of whether the market do a deeper pullback, which will be ideal. If not, the market will continue higher from where it closes on Friday, straight towards 6,221.5. So I think this will be my outlook for the near term. So you can take it as a benchmark and make sure you do your own analysis before you take up new positions. So this is all I have for you today. Take care.